Hello and welcome to the Al-Attiyah Foundation podcast. My name is Stephen Cole. Today, I'm delighted to be joined by Dr. Paul Horsnell. Paul is Global Head of Commodities at Standard Chartered PLC, where he covers energy and agricultural markets with analysts based in Singapore and London. He was previously Head of Commodities Research at Barclays and Head of Energy Research at JPMorgan. Prior to becoming a financial analyst, Paul was Assistant Director of Research at the Oxford Institute for Energy Studies for 10 years, where he authored books on the Brent oil market with Robert Mabro and on Asian energy markets. He's a former chairperson of the British Institute of Energy Economics. Paul, a very warm welcome to this podcast.
Oh, it's a pleasure to join you. Thank you very much for the invitation.
How do you assess the current state of the oil market, particularly, I think, in terms of supply and demand dynamics, and what factors do you see as driving any notable shifts?
Yeah, I think the current fundamentals are pretty constructive. On the demand side of the market, demand's come out fairly robust this year, very strong last year. This year, again, somewhat faster than the sort of pre-COVID averages. So somewhere around about 1.6, 1.7 million barrels a day of year-on-year growth this year. On the non-OPEC side, this is a bit of a slower year. There's a bit of extra production coming on from places like Guyana, from Brazil, but US production in particular has been extremely quiet, has been flatlining really since the middle of last year. And with US activity still falling even as prices rise, we're not expecting the US to provide a lot of incremental supply over the course of the next 6 months of the year. So overall, we do think that OPEC Plus have got the market pretty much under control, looking for some supply deficits over the course of the next 6 months, particularly over the next 3 months. So overall, that should be conditions under which prices can push up another $10 or so from their current sort of 85. So we're just definitely supporters of believing fundamentals this year can support a price above 90.
So pretty stable, Paul. What factors do you see as driving any possible notable shifts?
Obviously, the further out you go, longer term demand patterns are clearly key. As we take it on to, say, a medium term horizon, the key factors there are global GDP growth, as ever, is a key component. And obviously the rate of adoption of electric vehicles is going to play a large role in terms of when does oil demand start to plateau. We're not looking for peaks, but certainly for a plateau. I think on the current dynamic where EV take-up is slightly disappointing relative to perhaps some of the more optimistic projections, and where perhaps we're falling a little bit behind even the stated policy scenarios in terms of the energy transition. You're starting to look at pushing back the start of that plateau for oil demand into the next decade. So still think demand will continue to increase, and on the supply side, that's where the difficult economic decisions to be made by companies looking at long-term adjustments in a market where there is considerable longer-term demand uncertainty.
Has the redefinition of Brent had any impact on how oil markets work?
It hasn't affected overall price levels, but I think it's helped shore up confidence in what is the world's leading marker crude. So very important for market confidence. Brent serves a very useful function, and without it, it'd be very hard to find something else that could act as that benchmark role. So important to keep it going, and those changes, if they've and they do seem to have improved market confidence in the marker, clearly then are beneficial.
So very briefly, Paul, how has Brent been redefined?
Well, essentially, they've followed a process that's been going on for well, really for over 30 years, which is as the physical base of the Brent system itself declines, adding in other streams. So it started in the 90s by adding in the Ninian stream, and then added in elements of Forties and Osberg, and Norwegian Osberg, and Ekofisk. And this is perhaps the most radical addition in allowing that West Texas Intermediate to be added into that stream. So US exports priced out of Midland, Texas, exported out for delivery into the European market, allowing those to also be counted as marginal crudes in the determination of the daily Brent price, brought in obviously an extra source of liquidity. So that's quite an important change, because it brings together or at least creates a link between the two major world crude oil benchmarks, US WTI and North Sea Brent. And so that's really has padded out that physical base of Brent. So consistent with previous changes, but perhaps the most radical in terms of bringing in a US crude rather than just adding other UK or Norwegian crudes.
Gas markets, as you well know, are not as developed as oil markets. But how are they developing? And perhaps are they more vulnerable to disruptions? If which case, how are they coping?
In a sense, the economics of natural gas implies that they will always be more vulnerable to dislocations, partly because you think of what oil is. Oil, compared to most other commodities, is extremely costly to store relative to the value of the commodity itself. So you think of gold, $1,000 worth of gold is in quite a small space, and actually doesn't cost very much to store $1,000 of gold. It's only half an ounce. Whereas $1,000 worth of oil, that's a large, bulky liquid, and it costs. Now, following that logic on to gas, $1,000 worth of gas is a very large volume. The storage costs are considerable. The ratio of demand to inventories will always be lower for gas than it is for oil, and oil is going to be lower than it is for most of the metals. So in gases terms, we're never going to have enough inventory at the same time to last a very long time. It means that storage swings are going to play a larger role in gas than they do in oil. Seasonality matters a lot because of the seasonality of demand, and also the infrastructure for gas tends to be large projects, be that LNG internationally or fixed pipelines. So the vulnerability there to any sort of loss there, and certainly anything as traumatic for the market as the loss of most Russian supplies into Europe, that's a major dislocation through the market. Having said that, I think most people looking back and saying that the market managed to adapt and respond to the cutoff of Russian gas far better than I think anybody had expected. It proved much easier to remove Russian gas from most of the major European markets than was previously thought. LNG was able to swing in to take up some of the slack. The rest just came through demand reduction and, in some cases, demand suppression. So the market did all work. Again, it worked though because prices went up dramatically. So from where they were before Russia started to squeeze the gas market, and they started doing that in 21 before the invasion of Ukraine, from prices then to where they peaked, it was a 20-fold increase. So they worked, but at an economic cost within Europe, but did manage to hold together and show that gas can survive those kind of geopolitical shocks. So it does work, but again, at a serious cost. And I think Europe is still trying to work out in the longer term how to fill in those sort of gaps. How do you get prices down to levels which start pricing back some of the industry that's been lost without increasing vulnerability on, and particularly not wanting ever, I think, to go back to Russian supplies.
How much is the increase in energy prices driven by the way the energy markets work?
In terms of the pure structure, I think the short-term dynamics, the short-term volatility, the tendency of markets to overshoot and undershoot, that's all down to the composition of the markets and the nature of the players and the ratio, if you like, of fast money to slow money and factors beyond that. In the longer term, is the average price of energy any different compared to, say, markets which had less fast money or were structured in different ways? I'd say no. I think these are all sort of down to short-term dynamics. But in the very short term, when the market undershoots, it can, as it has done recently after an OPEC Plus meeting, it can be $10 out of kilter. And likewise, it can take a matter of weeks to re-establish what perhaps would have been the fair value before price had been pushed off by either momentum following the actions of CTAs, which are, I won't call them black boxes, but essentially algorithmic based trading. All of those factors can distort prices in the short run, but I don't think they're really going to make any kind of longer term difference to the averages.
You've mentioned some of the geopolitical tension and market volatility. How resilient do you perceive the oil market to be? Because from what you're saying, it seems to have not been affected dramatically by those geopolitical tensions. And what are the primary risks you see or you foresee impacting its stability in the near future?
Yeah, and part of that resilience and stability is due to the very deliberate policies of OPEC and Saudi Arabia in particular to try to stabilize the market at the margin by, as a matter of policy, maintaining a buffer of stable capacity. So it's that spare capacity which I think does act as the stabilizer, means that oil prices haven't been as volatile as say European gas prices have been, because there is that important market participant at the margin being prepared to utilize that spare capacity if necessary. It's a dual-edged sword. I think I too often see in market commentaries that spare capacity is a sign of market weakness, that the only reason that oil is off the market is because there isn't enough demand, etc., etc., etc. I just think that's false. It's a deliberate policy to maintain that. It does stabilize prices, and unless we get into interruptions where spare capacity starts looking challenged, then the volatility and responsiveness to some of the geopolitical developments, I think, is much more muted.
So tell us a little, Paul, about the trends you're seeing in the natural gas market, especially concerning the balance between traditional fossil fuels, the gas market as a low emission alternative to coal, and the growing presence of renewables.
Yes, and gases occupies a sort of fairly awkward position sort of within the energy transition, in that, roll back, and I used to work for a rather brilliant energy economist called Robert Mabro, who 30 years ago was describing gas as oil's sister fuel. It was and I remember him using the word transition in a rather different sense to the way perhaps we'd use it now. But what he meant was that gas would have a longer term future where the balance of energy demand started to shift away from coal and oil and towards gas. And so it was the next fuel down in the pecking order. I think within the energy transition, many of the policymakers just lump gas in with the other fossil fuels. It's not seen as a transition fuel. Personally, I think its role, it does have a role in there as a transition fuel, particularly in terms of the transition away from unabated coal. But it's not really been encouraged or priced into the market, I think, to take on that kind of full role. Within Europe at the moment, the policy narrative is still one of maximizing renewables, cutting back on gas, and perhaps not really understanding that you need something in there, some mixture within the overall fuel mix, which is capable of filling in for those periods when it's dark, so there isn't any solar, when the wind isn't blowing, so there isn't any wind.
Exactly.
You need that sort of swing fuel within inside the energy transition. Now, in the longer term, that might be battery storage, should technology and scaling permit it. But over the short to medium term, gas always has a role, I think, within that sort of a picture. So overall for gas, we still see demand increasing. There is, I think, a strand of opinion that sees natural gas demand peaking this decade. Again, we just don't see that. I think that any peak in natural gas demand is pushed out well into the next decade, if not into the 2040s.
I wonder if you're seeing any signs that in advanced economies, demand for fossil fuels is peaking.
Not really, or at least not in an unexplainable way. And I've already mentioned that gas demand in Europe is well down from its pre-Ukraine war levels, but we know why. I mean, that was a strong price effect. That wasn't a choice. You're seeing some OECD oil demand that actually peaked in 2005. I don't think anybody noticed it, and still today most people are very surprised that we're almost 20 years past the peak in OECD oil demand. But it's been gently falling over the course of a couple of decades, again without saying the world has continued without necessarily noticing it. And you see specific areas where oil demand in power generation within the OECD, and that peaked in the 80s. So there's lots of little niches and areas where definitely demand has peaked. But overall fossil fuel demand, I think the best you can see is a flattening. But in the very short term, demand has surprised to the upside, I think, for oil, gas and coal in each of the past 3 years, and we expect that to continue pushing on through the back end of this decade.
So we haven't reached, you don't think, peak gas yet?
No, we certainly haven't reached it yet. I think it's only a few of the scenarios that see peak gas over the course of the current decade. I think in most, the only way you can get to peak coal is by pushing back peak gas, and gas still has that substitution.
Coal's still very, very big in India, certainly in China.
And in China.
We've got to move on a bit faster, Paul, unfortunately, because I'm going to give you some exam questions now on hydrogen and the basic economics of hydrogen as an energy fuel. As a basic chemistry principle, will splitting molecules of water by electrolysis always be more expensive producing hydrogen from methane?
I should warn you, I'm not a scientist, and those members of my team who are very good scientists and have full background, this is the point where they normally dive under their desks and don't come out for quite some time afterwards. But in short, it's inevitable that it necessarily has to be more expensive. You think of what we're really comparing. If the cost of electrolysis is really for green hydrogen essentially is the cost of the renewable fuels themselves, whereas if we're doing it through mixing natural gas in, that's essentially the cost of natural gas is the major component. So it's not so much the chemistry, it's a bit of economics, it's that relative cost. So there can be circumstances where if you had very, very high natural gas prices and relatively low renewables prices, then you could have electrolysis being cheaper.
All right, well, let's move away.
But only Europe in the last couple of years. So yes, so it's definitely has been periods where it's been cheaper, but that's a function of high prices.
Let's allow your team to come out from underneath the desk and go back to your strong suit markets. Do you anticipate markets developing in hydrogen and ammonia for fuels?
Not independent. Honestly, there's obviously going to be a form of pricing that, but it's likely to be relative to natural gas prices, I think, for the sort of foreseeable future. I mean, the whole thing with hydrogen is to get it to work, it's got to be able to scale up. I mean, the only reason we're doing it is for attempt to reduce CO2 emissions, and to do that, it's got to be scaled up dramatically. And so I think we're at that stage there where markets aren't really the problem. In a way, probably even technology isn't the problem. It's that scaling up and the associated cost reduction economies of scale. That's what's currently missing, and that's what's holding it back. And so the mood music, I think, generally across hydrogen is those trying to bring forward hydrogen projects is a little bit more downbeat than it was a year ago or 2 years ago. And a lot of that is down to this sort of cost of scaling up. I mean, it's a very nice idea, but so far we haven't managed to work at the sort of scale that would be necessary to fit into some of the lower carbon scenarios. So we'll have, it's the areas which it still needs to be priced into, if it's going to work at all, would be things like steel, it would be maritime transport, it will have niches in power generation as well. But at the moment, the current expectations are that it's not quite scaling up fast enough to price itself into those sectors quickly.
I think that's a very fair summary. Lastly, Paul, and very briefly, if you will, tell us or talk us through the key developments and trends you think will shape fossil fuels markets, and the strategies you think that will be essential for market participants to capitalize on those opportunities.
Yeah, I mean, it is back to the energy's sort of major, I wouldn't say problem, but structural feature is, it's very expensive. Capital is very expensive. It tends to be very long term. But what's driving the market in the short term is largely governments. It is about policy. It's about regulation. It's about where they're positioning themselves inside the energy transition. And so, at top of the list now, I think probably is government policy and which way a government's facing, precisely how they impinging on the sector. I think it's making it harder for conventional companies to undertake those longer term investments, because there's a huge amount of regulatory uncertainty on top of the usual demand uncertainty. So I think those features are in there, but the logical who favors, it's anybody who's got produce large amounts of energy on fairly short-term projects, which have relatively low transport costs. You're in a very strong position, because you're going to be the swing supplier of energy across regions and across markets. So I still like being positioned in natural gas over that sort of medium-term period, because in most of those situations, think of, well, what would fill in? It probably is natural gas.
Okay. Paul, excellent answer, and that concludes our interview. On behalf of the Al-Attiyah Foundation, I'd like to thank you for joining us today and providing our listeners with your valuable insights as to how commodities markets work. The Foundation looks forward very much to continuing this conversation with you soon.
Well, thank you very much. It's been a pleasure to talk to you.
And thank you for listening. A new Al-Attiyah podcast will be released in the coming weeks. In the meantime, you can keep up to date with all of the Foundation's publications and news on our website and pages on X, formerly known as Twitter, and YouTube. From me, though, Stephen Cole, for the moment, goodbye.